Financial system failures are commonly explained as failures of discipline. Panic, irrational fear, loss of confidence. This explanation is incomplete. Failures are not reactions. They are outcomes embedded in system design long before the first visible stress appears. Have you ever noticed periods of calm that felt too stable? Comment below. What follows is not a narrative about sentiment. It is a description of mechanical causation. Incentives create leverage. Leverage accumulates under suppression. Constraints bind. Failure emerges automatically. Each stage builds upon the previous one silently before any market participant recognizes it. Every major structural failure begins with stability that cannot persist, not visible instability, but artificial stability enforced by policy or structural suppression. Stability produced by constraint rather than natural balance. This distinction defines the unfolding of mechanical failure. Where do you see similar artificially enforced stability today? Think globally, not just locally. Markets do not fail because participants lose belief. They fail because systems exceed their tolerance for leverage, duration, or liquidity mismatch. At that point, belief becomes irrelevant. You may hold positions that appear safe, yet under the surface, invisible constraints are quietly accumulating pressure. Systemic ruptures are not isolated events. They are mechanical failures revealed under stress. From the 17th century to the present, the pattern remains consistent. Instruments evolve, institutions adapt, technology accelerates execution, leverage structures remain constant. Understanding the terrain repeating sequence allows recognition before breakdown becomes obvious. Each structural failure begins with suppression, a rule, policy, or mechanism introduced to dampen volatility or enforce perceived stability. Interest rates are capped, risk weights adjusted, guarantees implied. Suppression is not neutral. It redistributes pressure silently, delaying recognition, while participants assume stability is natural and permanent. Where do you see hidden leverage today? In crypto derivatives, AI-driven funds, or real estate structures? Comment your observations. This reflection is critical because leverage hiding under artificial stability behaves like compressed energy, released suddenly when constraints fail. The Dutch Tulip collapse illustrates this clearly. It was not mass irrationality or panic. It was leverage applied to illiquid forward contracts with no secondary settlement infrastructure. Tulip prices multiplied tenfold within months, but contracts locked in 90% leverage. Participants could not fulfill obligations, and the system froze. Obligations exceeded liquidity. Confidence collapsed when delivery was demanded. Settlement failure preceded price adjustment. The market halted before any price could react. The breakdown was mechanical, not psychological. Function ceased while valuation remained unchanged. Early recognition of similar sequences today could reveal pressure points. The South Sea bubble followed the same structure. Sovereign debt was converted into equity exposure. Duration mismatch was hidden. Obligations were reframed as opportunity. Confidence replaced collateral. When conversion was required, liquidity vanished. The structure could not process redemption. Failure occurred at the settlement layer, not the narrative layer. Throughout the 18th and 19th centuries, railway manias repeated the same mechanics. Funding long-term infrastructure with short-term credit caused cash flow mismatches. Rollover became mandatory. When rollover failed, solvency followed. The breakdown was predictable from structural analysis, not sentiment. Duration risk and leverage dictated outcomes. The panic of 1907 demonstrates another structural failure. Trust concentrated inside, clearing intermediaries. No lender of last resort existed. Liquidity stopped when confidence crossed a threshold. The system froze abruptly. Payments failed before valuations adjusted. Function ceased while price signals remained. Mechanical causation was fully evident. The creation of central banking altered timing, not structure. Recognition of stress was delayed. The Great Depression followed the same sequence. Callable leverage, margin requirements, forced liquidation. Assets failed mechanically as counterparty trust evaporated. Human belief played no initiating role. The system's design ensured the outcome. The 1987 market breakdown was also mechanical. Portfolio insurance embedded automatic selling. Feedback loops replaced discretion. Liquidity evaporated inside algorithms. Prices moved after mechanical triggers. Traders reacted to execution, not news. Function failed before perception caught up. This is a repeating theme. Collapse occurs in mechanics before narrative. Long-term capital management repeated this pattern. Excess leverage built on convergence assumptions. Correlations converged instead. Margin requirements escalated. Funding evaporated. Central bank intervention preserved function, not structural integrity. Similar vulnerabilities exist today in AI-driven funds, derivatives, and leveraged ETFs, though less visible. The 2008 systemic rupture followed identical mechanics. Housing was not the cause. Collateral base and structured credit created hidden pressure. Subprime mortgages bundled into AAA-rated CDOS. Refinancing failed when home prices fell 1%, triggering $700 billion in bailouts. Counterparty trust collapsed mechanically before price adjustment. Post-2008 stability was enforced through monetary expansion and rate suppression. Leverage migrated from banks to markets. Duration risk accumulated invisibly. Non-bank entities absorbed risks previously contained. The same mechanical vulnerabilities persisted. Observe where leverage has shifted today and consider systemic exposure. The 2020 liquidity shock revealed the constraint. The pandemic acted as a trigger, not the root cause. Markets failed before economies did. Treasury liquidity fractured. Central banks became dealers of last resort. Price discovery was suspended to preserve function. Awareness of hidden constraints is essential to understanding risk. In 2025, pressure has migrated into opaque structures. Private credit exceeds $1.7 trillion. Non-bank lenders now hold risks that banks shed post-2008. Funding assumptions are fragile. Margin dependency is invisible. Duration mismatches accumulate silently. Which sectors are most vulnerable today? Comment your analysis below. AI-driven execution compresses reaction time. Feedback loops now operate at machine speed. Constraints enforced mechanically. Liquidity disappears discreetly. Margin adjusts instantly. Trust collapses faster than prices. Observe, the system fails in structure, not narrative. What becomes unstable next is not price. It is settlement assumptions, collateral reliability, and duration alignment. Historical breakdowns show identical structural patterns. Tables reveal sequences. Event, mechanical trigger. Outcome, tulip mania, illiquid forwards, settlement freeze, 2008, GFC, refinancing failure, counterparty collapse. Systemic failures are not surprises. They are delayed recognition of structural impossibility. The process is underway before awareness. Recognition allows analysis and risk adjustment. Human belief does not initiate breakdown, but mechanical causation dictates outcome. If you want to observe leverage before failure, examine where funding assumptions are unquestioned. Subscribe to follow part 2, where we will isolate the exact structural triggers as the regime approaches constraint. Comment your thoughts, predictions, and observations below.